Welcome to Smart Crypto, the channel where you will learn how to make money in the crypto market. Remember our previous video, where we introduced the concept that all financial markets are controlled or manipulated by smart money, and that smart money is driven by liquidity. Hi, my name is Luke, and in this video we will dive deeper into the liquidity concept and show where exactly you can find it on a chart and how to trade it. First of all, let me repeat that liquidity drives smart money and that smart money controls the markets. Truly understanding what makes smart money move will give you an invaluable edge in the market as a trader. You will understand how smart money manipulates price action to certain levels and suddenly reverses to continue in the direction of the main trend. In this session, we will look at the building blocks of liquidity, like swing points, equal price levels, and the importance of round numbers. Some distinguish between internal and external liquidity, and that is a good start. But for me, that doesn't really explain the reason why smart money is behaving in the way that it does. We must take our understanding to a next level. Let's start to explain what a liquidity pool is and how it is created. As I explained in the previous video, liquidity pools are created by stop losses, which are pending orders that are automatically converted into market orders once the stop level is reached. Automatically is the key word. Once traders have protected their trade with a stop loss, there is no turning back. You do not have the option of not converting your pending order to a market order once the price level is hit. This idea is fundamental to understand the concept of liquidity pools. Now that we know what a liquidity pool is, the next question is, where can I find it on a chart? Following our previous definition of a liquidity pool, you will find them where traders are putting their stop losses. So, where do traders put their stop losses? Normally, the stop loss will be below or above the entry level, depending whether it is for the protection of a long or a short trade. Some traders work with fixed stop loss levels, for example 20 or 30 pips, while others look for swing points or short-term market highs or lows close to the entry level. What is a swing point? A swing point is the basis of classical market structure. To bring some structure into the chaos of short-term price movements, Larry Williams introduced the concept of swing points in his book Long-Term Secrets to Short-Term Trading in 1999. In his definition, a short-term market low occurs any time when there is a low with lower lows on both sides of it, and a short-term market high occurs any time when there is a high with lower highs on both sides of it. We know this because a study of market action showed that prices descended to the daily low and then failed to make a lower low. Building further on this concept, we can also define nested swing points. The stronger the swing point, the more likely that it will be used by traders as a benchmark level for allocating their stop losses. Strong swing point levels are daily highs or lows. Above and below the daily high or low, there is a very high probability of finding stop losses. That makes the daily high and low some of the most favorite, if not the most favorite, target for smart money. To fully understand the power of daily highs or lows, let's analyze in some more detail the daily candle range. In this example, we are looking at the Friday, March 11 chart of Luna versus dollars on the 30-minute time frame. The gray horizontal lines indicate the daily high and low, while the green boxes are highlighting the swing points of the daily high and low. A swing point consists of 3 candles, a high surrounded by 2 lower highs at the upper side and a low surrounded by 2 higher lows on the lower side. Especially, but not necessarily, if the third candle is engulfing, buyers and sellers will enter the market believing that a short-term high or low has been formed and will put their protective stop losses just below or above the swing point. See the red boxes. The big black candle shows the corresponding daily range with high, open, close and low. The body of the candle is containing the bulk of the volume and possibly indicates the direction of the market until a key level has been reached. The next day, Saturday, March 12th, smart money manipulates the price lower, below the previous day low, taking out the sell-side liquidity, and from that point on, prices seem to reverse higher. The yellow area indicates a possible reversal area. Later we will specify why this level is important. Based on the daily range idea, 2 specific kinds of days can be distinguished: inside days and outside days. An inside day does not move outside the previous daily range, while the outside day breaks both the previous day high and low. Why is this important, you may ask? Well, it becomes interesting if you know that both inside and outside days only occur in about 7% of the trading days, which implies that in 86% of the trading days, either the high or the low of the previous day is attacked. Let me repeat this. Every trading day, there is an 86% probability that either the high or the low of the previous day will be taken out. If you have a clear high time frame bias to go long or short, these trades present bread and butter setups. An example of this can be seen in the following chart. Our high time frame bias is clearly bearish, because the last break of structure on the high time frame is bearish, and as long as the trend does not encounter a strong counter level, it will continue in the same direction. The next day, prices move higher from the daily open, creating relative equal highs, followed by a stop hunt of the buy-side liquidity, resting above the relative equal highs. Our short entry is at the breakaway level and the target is the previous day low. Another strong combination of swing points are equal highs or equal lows, or relative equal highs and equal lows. These combinations are often seen by the less informed traders as levels of support or resistance, and are very often used as levels where stop losses are allocated, making them very attractive liquidity pools for the smart money. These levels work as magnets. Price is attracted to these levels by smart money. An example can be seen on the following chart. First, the relative equal low are attacked and taken out, and then price action turns around and takes out the relative equal highs. A last combination is a swing point at or close to a round number. Smart money or institutional money does not operate with decimal numbers. They like to trade with round numbers, just for convenience sake. The other types of important swing points, like daily high and low and equal highs and equal lows, can often be found at or close to these round numbers. The most important round number levels are 00, 20, 50 and 80 level. An example of this can be seen on the following chart. Price action moves nicely from key level to key level. See the green dots. What to remember from this video? Smart money is in control of all financial markets, and one of the most important drivers of smart money are liquidity pools. liquidity pools are formed by pending stop-loss orders. Pending stop-loss orders can be found at or around swing points. Important swing points are daily high and low, equal high, equal low, and round numbers. If you like this video, please give it a thumbs up. If you are interested in finding out more, be sure to subscribe to our channel so that you don't miss out on any of our future videos. Thanks for watching, and in life and well-being, see you in our next video.